I am officially old. Em got me this card, just one sec. It says, bad news, you are 30. Good news, I'm not. Happy birthday. Now, turning 30 gives me a new perspective on life. I've always thought through my, being 15, 16, 17, 18, 30 is so far away. That's 2 lifetimes when I was 15 years old. But now being 30, you realize how quickly life goes by and that there are more important things in life, more important things than money. But money can give you choices. Money can give you choices in terms of your time and what you do. It's going to magnify who you are. If you're a generous person, when you have a little bit of money, you'll continue to be generous with more money. If you're able to spend your time with your family and your friends and kids while you're building your wealth, you'll be able to spend even more time with them as you've grown out your wealth from there. So in this video, I want to talk about 20 things I learned in my 20s. Not all property related, but it is going to be somewhat related as well. The first thing on my list is to start early. Like I said, 15, 16, 17, 18. As a 15-year-old, I was interested in property investment, would you believe? I used to read the Australian property investment magazines. I even might have one. It's like show and tell. I've even got one still in my cupboard, of the Hot 100, the most anticipated list of areas set to boom. And this is dated, I don't know if you can see that. It's September 2010. So man, this is a piece of history right here, 14 years old. Now, my property investing journey really started in 2018, but as you can see, there were magazines around from 2010 that I was reading. And what this means is start early, not just in terms of your savings, but start early in terms of your mindset, in terms of building out a property portfolio or investing for your future, whether that's in business or shares or life in general. You need to plan things out earlier in advance. So as a 16, 17-year-old, I knew that I wanted to create wealth, and I started researching at that point in time. Number 2 is education will pay off. Now, I deliberately went into accounting because I knew there was going to be a crossover between accounting, business, and property. And that's formal education, university degrees, TAFE courses, but more so than that, the education of property forums, YouTube videos, podcasts. In my opinion, it is invaluable. Now, don't just listen to my videos or other videos or podcasts out there. Take notes. I had a spreadsheet before I'd even started investing in property that I'd taken down some major notes of some key concepts, trust structures, leverage and borrowing capacity, some key things that were relevant to me and my property journey. So when you're reading forums, listening to videos or podcasts like this, then make sure you're taking down notes that are relevant to you and your journey so you can refer back to them later. Number 3 is to save for your deposit. You're going to need to start with some money in the bank. Now, saving for a deposit, you can look at lots of different methods, especially if you're a first home buyer. So when you're saving for that first deposit, of course, you need to look at your bank statements. Go through your bank statements with a pen and paper or digitally these days and pull apart exactly where you're spending your money. On top of that, look at ways you can save a deposit faster. For Emily and I, we were one of the first people to jump onto the First Home Super Saver scheme, which saved us about $5,000 each in terms of taxes and allowed us to fast track that deposit together for our first home. Number 4 on the list is consider growth. People want to find cash flow in this market because there are interest rates at 6 to 7, even up to 7.5%, 8% for some of our buyers. If you're looking at an interest rate between 6 to 8%, a lot of people are getting focused on the cash flows. But what I want to point out to you during my 20s is that we focused on growth first. When you're looking to buy and invest in the markets, then growth is what's going to create that massive amount of equity to allow you to leverage and go again. Now, there's 2 types of growth. There's manufactured growth and there's market growth. So you can either manufacture the value through developments, cosmetic renovations, raising a home like we've done here. But when you're starting out, cosmetic renovations is a very low barrier to entry, but high return because of the cost of trades and materials at this point in time. So you've got manufactured growth, but then also consider market growth. The location is going to do the heavy lifting. So be borderless. If you're living in Sydney or Melbourne and you can't afford to break into the housing market where land is the scarce asset, then maybe look at Perth, Brisbane, Adelaide, or maybe look at a major regional location where you can get good underlying land value because land is going to do the heavy lifting. So don't be focused too much on cash flow and focus on growth when you're in your 20s. Number 5 on my list is team up. If you've got a partner that's in this with you, it can make a massive difference. It wasn't just me, pushing forward in terms of the property journey. I know you might see my face here on the YouTube channel. It's Luke Wiles, and it's not just me in this game. It's myself and Emily. My wife is our bedrock when it comes to building this property portfolio. Without her, we wouldn't be anywhere near where we are today in terms of our property journey. There's a couple of reasons for that. Because we were able to team up, we're able to bring together our serviceability. So that boosted our borrowing capacity. We're also able to lower our expenses as a couple by living together. And two people sharing a can of beans and rice, it's a lot cheaper in my mind when you're in your 20s and you're saving up. So teaming up can make a massive difference. Now, it doesn't have to be a romantic partner, it doesn't have to be your wife, but ideally it is someone that you're very aligned with and you're never really wanting to break ties. Because what can happen is you can get tied together for a long period of time. Property is a long-term game, so whoever you're teaming up with, whether that's a brother, sister, cousin, wife, make sure that this is a long-term decision, and then you're going to get the benefits of that dual income to service the debt and maybe reducing your expenses as well along the way, and you're aligned in terms of your strategy. This leads me into number 6, which is values. It's hard to know where you're going unless you understand your own inherent values. Why am I investing in property? You'll have heard this over, time and time again. What is the reason I'm doing this? Well, for me, the big motivator, the extrinsic motivator for me was I want to get out of this day job. I don't want a boss to tell me that I need to rock up to work for 8 a.m. and return home at 6 p.m. every day of the week. And I did that for $50,000 a year in my first 3 years working as an accountant. Now, I was very extrinsically motivated to not want to have that boss putting that pressure on me and making me come into work every week. I wanted the options to do what I wanted with my own time. Now, it doesn't mean I don't work. I talk to clients every day. I look at deals, I negotiate, I look at houses. There's still work involved regardless of what you're doing, but it's about that value alignment. On the flip side, the intrinsic motivator was time with family, focusing on my faith, focusing on my football and fitness. I like to talk about those things. Faith, football, fitness, they're all things that are important to me. So they're intrinsically motivating me to want to be financially free. So the reason I invested in property was to live out those values. 1, I don't want to have a boss over me, but 2, intrinsically, I wanted to look after my family and spend more time with them and take on other passion projects and ventures. That's why our business here is called Purpose Property, because every property in your portfolio should have a purpose, but building a property portfolio should help you live out your purpose. So that's why values at number 6 is so important. This leads me into number 7, which is looking at your wider team. So who are you working with to help you build up that property portfolio? Now, starting out when we bought our first property in 2018, I dealt directly with CBA, Australia's biggest bank. And it's about who you find in the bank. I clearly remember finding Sarah, one of the direct lenders at CBA, and she was fantastic to work with as an individual. Yes, CBA is a massive organization. Who you work with individually has a massive impact on where you're going to head financially in the future. So build a team around you that's values aligned, that are really good at what they do. They're experts in their field, accountants, solicitors, building and pest inspectors, mortgage brokers. They're all going to be key to your property journey. Number 8 is understanding the finance game. Property is 50% property. The other 50% is finances. You need to make sure that you've got your finances in order. That means maximizing your serviceability, and this can be done over periods of time. For Emily and my journey, we were able to achieve a $5 million property portfolio while we were on very reasonable incomes in terms of Australian incomes here. I can tell you exactly what my wages were year on year. I started at $45,000, I went to $50,000, I went to $60,000, $80,000, $100,000, and $120,000 from years 1 to 6 in my working career. Emily was pretty much on an identical trajectory, and we used to compete, racing to who could get to $100,000 gross income first. Now, as a couple, obviously you double those numbers. So we had a $100,000 household income, which eventually grew to close to $250,000 household income. Now, for most double income families, that's fairly reasonable as to what most people would earn. When we started investing in 2018, interest rates were around that 5.5% to 6%. Yes, rates did drop, and that's why it's very important to understand the finance game and leverage when it makes sense for you as a investing couple if you're looking at that situation. You need to look at when you can boost your capacity and go out there and make acquisitions and then consolidate for a period of time. We've actually gone and done this year where we sold one of our assets and we bought 2 more investments to spread our risk and to also manufacture more value. And that came down to the finances. When we chatted with our broker, chatted with the banks, we were able to leverage and continue growing the property portfolio. So look at your situation and how you can continue using your finances to grow out that asset base. Now, number 9 is to diversify. You'll hear this, people want you to diversify between stocks, between business or your day job, your property investment portfolio. Now, when I say diversify, I don't mean buy 10 apartments across Australia because those assets are going to do well for you. I mean diversify with risk tolerance in mind. Now, currently Emily and I own 4 houses here in Brisbane. We've got 2 more expensive properties and 2 more affordable properties. So with our Brisbane exposure, we have around that $5 million asset base. When we're looking outside of Brisbane, we've bought the Coffs Harbour unit block. Now, if you go back through our timeline, we bought Coffs as our 4th purchase. So we bought 3 houses here in southeast Queensland, and then we went and bought a unit block in Coffs Harbour. The reason we made that decision is it was a major regional market with a diverse economy. They've got tourism, they've got industrial work down there, they've got agriculture. So there's a number of industries there supporting that local area, and around 100,000 people in that northern New South Wales Coffs Harbour region. So when we were diversifying with our risk tolerance in mind. Now, for some people, you might want to pick up houses across different states because of the price points, but just be wary of diversification. It can be a good and bad thing, so diversify when it makes sense. And so for us in 2021, after we built out our blue chip asset base here in southeast Queensland, we then went and bought in a major regional market like Coffs Harbour to diversify our property portfolio. Now, I've gone and bought and sold 1 property this year and bought 2 more here in southeast Queensland, but that's because I'm very bullish on this Brisbane market over the next 5 to 7 years. But it doesn't mean I want all my eggs in the Brisbane market. Even as a Brisbane buyer's agent, I say that to people. If you've got 100% of your portfolio here in Brisbane, just be wary of that risk tolerance to diversify and spread your risk across Australia. This leads into doing your due diligence. So number 10 is thoroughly researching your deals. This is from the numbers point of view and from the qualitative point of view as well. Look at the metrics, the yield, the price point, all the additional costs involved. Make sure you're running those detailed numbers and looking at the compounding growth calculators and how you can potentially use offset accounts to your power. So do your due diligence on each of those deals to make sure you've had a thorough look over the property. It's ticking your boxes in terms of it being investment grade, and that's going to be crucial to you building out going forward. Number 11 is putting the right manager in place. Emily and I have had some different property managers over the years, but find ones that you resonate with on an individual basis. Again, it comes down to the person that you're working with and the systems they have in place. So vet a few managers, look at their different fee structures, and pick the right property manager to make your investing journey far less stressful, because picking the right tenant and the right manager can make property more passive. It's not completely passive, but more passive than it otherwise could be. Number 12 is the power of leverage and risk. Going back when we were building out our property portfolio, we had so many people in our ear saying, think of the debt. The bank owns all your properties. I get those comments all the time. The bank owns 80% of what you've bought. Well, that can be true. The bank in our case might own 50% now of our property portfolio. But it doesn't mean that it's not worth taking that risk. There's always going to be naysayers. There's always going to be people yapping in your ear going, Luke, it's not worth the risk. The market's going to crash. Things are going to go fall over. In my opinion, if you don't take the risk, then you're actually worse off than taking the risk. If you sit on your hands and do nothing, that's far riskier to me than going out there and having a crack. Now, there's a lot of emotions around property and there's a lot of emotions around investors providing housing here in the Australian market, but it's the way the system is set up. So if you're willing to take on the debt and the banks are willing to give you the money and you can buy a good quality asset and you've done your due diligence, then leverage is going to be a powerful tool to you to give you that bigger asset exposure and give you access to compounding returns on that larger asset base. So take the risk. Don't do it without thinking, but take the risk and use leverage to your advantage. Number 13 is to be patient. You know, you've built out a property portfolio, you've built an asset base. I remember in my 20s thinking, I want this to happen overnight. Now we've had a COVID boom, and I say to Emily all the time, I think that's brought us forward 5 to 10 years on the growth that we were actually expecting and projecting here in the Brisbane market. But the difference is we took action and then we were patient. The times I've been least successful in my investing journey in my 20s was when I was impatient. And it maybe triggered my alopecia because of the stress and the workload that I took on. And we did a flip project in 2023 where I was very impatient. I wanted more money, I wanted it faster, I wanted to get my hands dirty and add value. And that taught me a harsh lesson. A lot of driving, a lot of time slogging out doing renovations, and making about $5 an hour at the end of it all. Being impatient can actually get you in a lot of trouble, and it increases the stress and risk profile massively. If you have a much longer time horizon, it really takes the stress out of our investing decisions. And even I can say that this year with one of the projects we bought, which will be on YouTube in 2025, we're doing a reno on it at the moment, and because I'm not stressed about it, I've got the buffers in place, I've got the time knowing this is a long-term investing decision, then it's allowing me to be patient and play that long-term game. Number 14 is to find others around you who have similar goals and values. Now, we spoke earlier about teaming up, we spoke about finding the right team, but number 14, and I found this through my 20s, that a lot of my friends weren't necessarily interested in property investing. They had no interest in renovating, they had no interest in trying to do that side hustle on top of their day job, which I totally understand. It's a lot of work and it's a big commitment. But find people who are on the same journey. Other investors, whether that's through forums, whether that's through events or connections that you can make, find people who are going on the same journey as you. You can then bounce ideas off each other. It's not a win-lose game here when you're talking with other people. It's the reason I share so much free value or try to create value for you guys here on YouTube by sharing my knowledge and insights. We can all do well out of this, and we can all help lift each other up. So find mentors or relationships with other people that can help you move your journey along faster. I can think of a few people in my life who've had a massive impact in terms of my property journey. The ability to understand the numbers, see what they've done because they're a few steps down the road. And that could be people I listen to on podcasts, that could be people that I know personally, but it's made a massive difference in terms of me seeing where I can go in terms of this property journey. Number 15 is to use technology to your advantage. We have so many data points now, so many hotspot maps, median suburb prices, vacancy rates, all the underlying data that used to be in these property investing magazines back in the day. If you flick to the back here, there it is right there. They've got number of houses sold, median prices, quarterly growth, monthly growth over a year, 3-year growth, 5-year growth, 10-year growth, weekly rent, gross rental yield, average days on market, and used to have to get all of that out of the back of a magazine. Now we've got all of this data in Excel spreadsheets, and we've got the Australian Bureau of Statistics available data that you can download yourself, and a lot of tools out there that you can pay for. Use the tools to your advantage. In my business at Purpose Property, I've got myself and 5 staff members who are quarterly reviewing the data of local Brisbane suburbs, but over the top of that, we're overlaying our local knowledge and expertise and qualitative outlook to make the right investing decisions. So as a young person in your 20s, don't be afraid to have a crack at looking at the data. If you hand this over to a buyer's agent or another expert, you're outsourcing it, which can be valuable, but it's also important to understand what you're looking at so you can make an informed decision. Number 16 is refinancing. Refinancing is probably the key word that have allowed Emily and I to be where we are today. We've looked at every property we've bought, and we've refinanced every property we've ever purchased at least once, if not 2 or 3 or 4 times. Refinancing is drawing down on the equity available to use those funds, which is essentially 100% debt, to finance and pay a deposit for the next purchase. What people don't understand is if you have enough money in that kitty, if you've got enough money that you can refinance, say you can draw down $200,000, but you only need to spend $100,000 on the deposit, you can use that remaining 100 grand to renovate homes. You can use that remaining 100 grand to service the debt as a cash buffer. So when it comes to refinancing, don't just understand that you can access equity, but also look at the ability to use offset accounts and to use liquidity to control a larger asset base. Number 17 is don't be afraid to sell. When I first started out in my 20s, I said I would never sell. I'm not selling a piece of property that I ever buy. It doesn't make sense. I'm spending I think $500,000, $600,000, $700,000, $800,000 on these properties at the time. And why would I ever sell them? I'm making a 15, 20-year decision here. Now, I backtrack on that statement from 2018 when I was about 23 years old and we bought our first home. We bought our second investment property in 2020, so about 2 years later when I was about 25. And at the ages of 25, 26, I'm going, okay, I'm never going to sell. But now in 2024, we've gone and sold one of our properties at the age of 29. And so what changed between 25, 26 and 29? It was understanding that assets can serve their purpose. If I bought that property, it's done what it's needed to do, which that property in Everton Park needed to grow for us to create more cash and create more equity in our portfolio. If I sell that asset and I can buy more assets, then it's absolutely a great deal there to sell that property and buy 2 more. And that's what we've done this year in 2024. We sold our Everton Park property for a premium, taking that cash and capital gain, and then using the funds as well as debt to buy 2 more properties. So just be wary of that in your 20s, that don't get stuck into holding forever. It may make sense to sell some of your properties throughout that property journey. Number 18 is take a holiday. You're in your 20s. Like, I didn't sacrifice holidays at all. I don't think. You know, we've missed out on some holidays due to some health concerns with Em over the last couple of years. But prior to that, we did a lot of holidays. We went skiing in Japan. We did a full Europe trip a couple of years ago. We had plans to go to New Zealand. We did Tasmania. Enjoy your life, enjoy your holidays. You're not gonna look back and go, I regret going on those holidays. Now, don't go to the 5-star hotels. Stay in the backpackers or stay in the hostel. Stay in cheaper accommodation, 3-star places. You're not gonna remember the accommodation as much as you're gonna remember the locations and the experiences. So when we did Europe, I even shared a full breakdown of our European travel budget, and it was fairly conservative. You know, we're not spending crazy amounts of money going on these holidays. Yes, it's $10,000 per person for Europe, but that's fairly reasonable for most everyday people. And it might set you back 10K, but the experiences are well worth it. So take your holidays in your 20s. You only get this body once on this earth. And so make sure you go out there and enjoy it, and don't just sacrifice everything to try and reach, you know, that golden ticket at the end. Enjoy your journey along the way and have your holidays. Number 19 is be okay with setbacks. Setbacks happen to everyone. I mean, they've even happened in Emily and my journey. We haven't made any huge errors, which is why we're sitting on that $7.5 to $8 million asset base now in terms of our residential property portfolio. But some people do make major mistakes. I personally know people that bought multiple houses in mining towns in the 2000s and lost millions of dollars. I've heard of people who've lost their jobs or have had health issues or have had their businesses collapse. So whatever financial situation you're going through, know that you're going to go through setbacks throughout the journey. It's not all going to be sunshine and rainbows. So deal with the setbacks and look at your vision and your values moving forward and keep pressing on. Which leads me into number 20, which is enjoy it. Enjoy the journey. You only get your 20s once. And yes, this is a 20 things I learned in my 20s list that is focused on the property investment side. But enjoy the whole journey. It goes so quickly. People will always tell you that. But investing is for your future, but living is for right now. So yeah, enjoy the journey. Keep investing for your future as well. And do what you love. I think that's the most important thing. If you're interested in buying a property or you just want to have a chat with myself and you're looking to buy a property here in Southeast Queensland in the next 3 to 6 months, head over to purposeproperty.com.au to book in a chat with myself. If you want to leverage off my knowledge and skills as well, we also have a real estate investing course for less than $1,000 called Invest with Purpose. You can also head over to purposeproperty.com.au and click on course and you'll find it there. If you use the code 20, if there's still some available, you'll get 20% off the course. So that is 20 things I learned in my 20s. Which one do you think is the most important point out of the 20? I'd love to hear you in the comments below. Thanks for sticking around, and I'll see you in the next one. Peace.